Hey, welcome back to The Dive. Today on the show, we have the Chief Commodity Strategist for Bloomberg, Mike McGlone. Mike is here today to share his thoughts about FTX filing for Chapter 11 and the impact this has on the cryptoverse, OPEC cutting oil production, the surging diesel price, China easing COVID policies and what this could mean for the economy. And he's going to give us an outlook for gold. Hey, Mike, welcome back to The Dive.
Hello, Cassandra. Thank you for having me back.
Yes, thank you so much for joining us again today. So, Mike, there's a lot of big news going on in the crypto world. This week, we saw Genesis halt customer withdrawals following the FTX insolvency, amongst various others. How do you think this impacts the crypto space?
This is part of the tide going out. We're finding out who's wearing clothes. And coming from futures, this is just rinse and repeat, seen it many times. Classic is commingling funds and too much speculation. And it's just the fastest horse in the race that went up the most, going down the most. And it's the contagion trickle-down effects for everything. So for cryptos, obviously, this is part of that ebbing tide, part of that, but within the macroeconomic context of what's happening with the Fed and other risk assets. So for cryptos, I think this is forcing people to hit stops. I think we're at the stage now we're much more likely to be carving out a low of pain versus that high we had of gain. It's just a question when we bottom and where we come out of it.
So given the current situation, how do you think this all impacts the price action of Bitcoin?
Yeah, so I think Bitcoin broke down hard for a good reason that you mentioned. I think it has further downside, and I'm looking for it to, first of all, start optimistically. In the big picture, I still see the base case for Bitcoin is a nascent risk-reward, nascent asset/technology that's going to advance over time. But in the meantime, we're in that pain stage that was compared to the internet stocks around 2000, 2002. So it might reach a very good floor around 10,000 to 12,000 there. That's very solid support. And then eventually at some point it's going to come out ahead and resume that upward trajectory. One thing I've been watching, keep a close eye on, is Ethereum. Ethereum around 1,200 as we speak on Thursday the 17th is still up about 12x from the end of 2019, which is right before COVID hit. So let's look at that level around 10,000, as 1,000 is a pretty good solid support. And what I see happening now is it's the contagion trickle down that's more significant. So for instance, on November 8th, when the FTX, Sam Bankman-Fried first came out, the first thing I noticed is people hit stops in crude oil. Crude oil is hovering up and hit stops. Stock market's coming a little bit later, but to me, that's the problem what's happening. This is a contagion, and every single risk manager and fiduciary on the planet now is double checking all their risk managers, all their assets, and everybody they have connections with. And this is just part of that trickle down. And it's also, it's causing people to hit stops in most assets.
Now, OPEC lowered estimates for how much crude oil it will pump this quarter by 520,000 barrels a day, following a similar size cut last month. If OPEC decides to keep cutting oil production, where do you think the price of oil is going?
I do love that analogy, Cassandra. The key thing to remember about OPEC cuts is typically they coincide with bear markets and lower prices, and OPEC pointed that out when they said about a month ago, they were going to cut 2 million barrels. And I went back and checked the history. The biggest OPEC cuts in history have coincided with sharp market declines. So they see what's happening in markets. They see demand destruction, early days, global GDP, all the estimates from global GDP are currently the trajectory is clearly downward. It's going to take a trough and some form of recovery in that. And in the meantime, they should keep cutting supply because they're a cartel. Their job is to keep prices up and help manage the market. But overall, this is part of the bear market I see in crude oil that's peaked in late March, April, just like it did in July of 2008 from a lower level of peak this time. So OPEC cuts to me are just coincident in this case. And the key thing to remember about OPEC is they're becoming increasingly less significant in this space. So in 2007, 8 or so, they were maybe 40% of global production. Now they're less than 30%. You see that trend? It's becoming less and less. The number one factor in all of energy and commodities right now is the trajectory of demand destruction, which is early days, most notably energy, crude oil, natural gas. and the proliferation, the continued trend of North American supply exceeding demand. That was the number one force that pressured prices from the peak in 2008. It's still there. It's coming back. The key thing that happened since then is not only production went up, but U.S. consumption peaked. Chinese crude oil has rolled over. Yes, it might come back with COVID, but don't forget we have a property crisis in the country that's really clearly heading downward. And U.S. unleaded gas demand, we pointed out, peaked in January. So this is a 2008 type scenario. I think the greater risk is crude oil WTI heads towards 50 than stays above 100 now.
Do you think that it would be a rational move for the U.S. to nationalize oil production on some level?
Yeah, it depends on how you describe nationalization. My thought initially when the war hit, we might have some war production legislation. But the most important thing, I think, for the U.S. and Canada combined is don't mess this up. That has been the kind of thing that the Biden administration has not handled so well. They've been acting kind of like Atlas Shrugged and Ayn Rand Navel in terms of U.S. drilling and production. The first thing they did when they came in the office is cut back on drilling, the ability for U.S. Energy producers to produce energy from a traditional standpoint and focus on renewables. Now, yeah, that was a mistake. We do need renewables, but now we have this war going on. So I think just let natural rules of Adam Smith and the invisible hand work out. We're going to get out of this no problem. But that's already started to happen really as we're in mid-November. We've had that spike in energy. And the key thing that we need to point out that's happened in the stages, yes, the supply hasn't come back on as much, but demand has indeed. The demand's rolling over. But the thing that's really significant about this, Cassandra, is how it really tilted, I think, this whole situation towards one of the most significant global macroeconomic resets ever. Spiking energy, accelerated inflation, which is temporary, and accelerated Fed rate hikes. And now the rest of the world followed, and now they just made that pendulum swing way too far. And now at this point, it's all swinging back the other way. Our chief economist, Anna Wong, her model for U.S. recession is at 100%. And part of that is spiking energy and spiking rates. They're still hiking rates. Our European models towards recession, China is somewhat subject, but it's still probably going towards recession. And all that's happened with the price of crude oil right now. It's still almost double the U.S. cost of production. And we see the demand destruction. So I think crude oil was one of the biggest bait and switches ever. It baited into this higher rates. It baited people to believe in higher inflation. And I think when we're talking about this a year from now, we're going to be talking about enduring deflation and why the Fed needs to do to help that out by cutting rates.
According to the IEA, the diesel price relative to crude surged to record levels in October and is now 70% higher than a year ago. What impact do you think surging diesel prices will have on the economy?
Demand destruction, the 2 Ds. Now, a lot of that's logistics. A lot of it's been ended up in the Northeast. I was shocked when my colleague in the Bloomberg Energy team, Fernando Valle, pointed out that I lived in the Northeast for the last 30 years. A lot of that fuel came from Russia because of constraints with logistics and distribution and transportation, most notably a lack of supply in pipelines through the whole state of New York and pushing back on horizontal drilling and fracking and all these new techniques. It's kind of strange, but that will probably go away. So that to me is part of that demand destruction. It doesn't really have too much of an impact on crude oil because that's a distillate. It's on the other end. It's actually some of a bearish factor for crude oil because it creates more of that demand destruction in the bigger picture. So to me, it's going to all be worked out logistically, just like we worked out through supply chains issue, just like how we've got through vaccinations. And so it's just a matter of time. But to me, it's part of the noise of what you see when markets adjust, and particularly with what happened with this major issue with the Russians, Mr. Putin's invasion of the Ukraine.
Okay, now let's come back and talk a bit about China. China has eased some pandemic policies, but kept their stance on zero COVID. What impact do you think that this has on the global economy?
China's key thing to remember about China is the micro and macro are quite negative and bad. Now, we've been pointing out the negative macro for at least 5 years. The micros, maybe they'll release restrictions and all that demand will come back and it'll be pent up and everything. And I'm like, yeah, good luck with that one. Number one reason they're in the lockdowns is because the Premier Xi was not able to get his his whole entire country vaccinated. Now, we did that relatively easily, which was a bit of a paradigm shift. And I have to mention his name because it's no longer China anymore. It's Mr. Z. Mr. Z has completely grabbed power as very autocratic leader, and we've seen the parallels with the Soviet Union, how these things usually don't work in history, and all those signs are kicking in China. So let's say that China does come out of the lockdowns, then they're facing a very significant property crisis. My team, economics team, I'm being part of Bloomberg Intelligence, based in Asia, said there's another 25% to drop in China's property crisis. My EM master, Damien Sassar, says China is a collapsing pyramid. Now, these are things we pointed out for a long time. But what you saw recently, to me, and when Mr. Z cozied up with Mr. Putin right before the invasion, that was one of the biggest political mistakes ever, I think, made by a leader. Now, we see many, but in our recent times. The good news is Mr. Z has realized that, is pushing back on Russia, and the latest we've seen from the G20 agreement with him and cozying up to Mr. Biden. It's like, yeah, maybe I shouldn't be so upset. Maybe I shouldn't push back so much on the world's largest importer when I'm the world's largest exporter. That was just so strange to see that happen. So what I see happening now with the whole Mr. Z situation related to China, we have a country in decline, parallels to the Soviet Union, and when Japan peaked in the 90s. I was there. I was in the trading pits, and the whole world's tilting towards recession. So to me, that's part of that pressure factor for crude oil. Copper's been a leading indicator. Now we have a new pressure factor in all the grains. They were held up because of the invasion. This is a big deal when you're from the Corn Belt and you relate to all the grains coming from Canada. But all that pressure, all that support factor from the invasion, because Ukraine's basically pushed back Russia, it's coming back the other way, supply coming back.
Okay, so Mike, before we let you go here, we wanted to get your take about gold. The price is now hovering above $1,750. What do you think needs to happen in order for the gold price to hit its all-time highs again?
So first, I'll give you my outlook for gold. I think it's a matter of time that the dollar price of gold gets above $2,000 an ounce and never looks back. It has made new highs in the euro and the yen this year, which is indicative of what's happened. This massive strength in the dollar, and gold's been doing what it's supposed to do in terms of currency debasement. Is protecting its owners and countries that have currencies are debasing. But that sledgehammer from the Fed is historical and precedented, and it's going away. At some point, I think gold is going to be one of the absolute best performers in commodities, particularly potentially next year. I've been too early. I've been wrong, but it's also not profound. Gold is one of the best performers amongst versus all commodities, particularly on a total return basis, because it doesn't have to cost a lot to store it. Over time, I think that's going to really accelerate next year as my base case kicks in. And my base case is global recession, Fed stops tightening, starts getting major pressure to ease. The problem is they will not be able to ease with the ease that they have in the past ever because of issues of inflation. But gold should be one of the better assets to outperform in this world that I see next year, heading towards what I said earlier, one of the greatest macroeconomic resets in history. And one thing that's happening right now in mid-November that's really almost unprecedented, except since 1929, is when you have declining global GDP clearly heading lower, the U.S. potentially probably 100% chance of recession, as I mentioned earlier, and the Fed still pounding hard. The forward-looking measures of Fed rate hikes, like a year from now, still priced for tightening. That's a shocker. That means batten down the hatches, expect lower asset prices and everything, and this should benefit gold. And it's already getting there now. At this point now, it's down about 4% on the year. Copper's down about 16%. I think the inflection we're going to see is crude oil breaking down, corn breaking down, most commodities breaking down, kicking in those forward-looking deflationary measures, and gold coming out ahead.
Okay, Mike, well, thank you so much for coming on. Would you mind sharing with our audience where they can go to hear more of your commentary?
Well, on Twitter, I'm Mike McGlone 11, and on LinkedIn, just look for Mike McGlone Bloomberg and shoot me a message, and I'm happy to add you in my distribution list. And thank you for having me.
Yeah, thank you very much for joining us again. We'll see you again soon, Mike. Thank you all so much for tuning in today. We will be back again tomorrow, so make sure to hit that notification bell before you leave so you don't miss out. Bye.